I'm joined by economics professor at the Gordon Institute of Business Science, Dr. Adrian Saville. Thank you very much, Dr. Saville, for joining us. The oil price has come down, yes, but for as long as it's above that $110 a barrel level, I suppose we should really all brace ourselves for a markedly higher oil price. Fuel price.
Yeah, and it's very much almost a play it moment by moment scenario. Quite literally, as we're speaking, the talks that were going on in Turkey seem to have come to an end without consequence, and the oil price has responded, heading back higher. You know, some analysts are talking about oil prices in the high $100 a barrel, even $200 a barrel, and that might be the land of speculation, but it is worth considering, what that might mean for the global economy and certainly for a South African economy, which has been under strain for a long time. And so, as you suggested in the intro, my back of the envelope calculation was to get a sense of what it might look like if the oil price were to hang around this $130 a barrel. And that translates into a high 25 Rand per litre for 95, if we can be more exact. And it assumes that the Rand hangs on to the strength that it seems to have found in a very, very difficult environment.
Yeah, well, let's touch on that. Part of the reason we heard that the Rand has strengthened was because of higher commodity prices, but we're learning that commodity prices have lost their steam. So therefore, does that mean that we can expect a reversal in Rand's strength?
Well, Nompu, there's a couple of things going on with commodity prices. The one is, when we talk about, you suggest they've lost some steam, that's after them having spiked already quite spectacularly. And there have been some big moves in commodity prices. And for the South African economy, coal, diamonds, gold and platinum are all important beneficiaries of the supply chain challenge that will come out of the sanctions imposed on Russia. At the same time, and this might be at the margin, but at the same time, there's been a small rotation in capital markets from allocating to Russia to looking to other places that capital can go in emerging markets. So I think South Africa is a beneficiary of that, and that also will have helped the Rand.
So do you think that there are any levers that government can pull or use to give the South African public some respite, regardless of what the price will be, because we know it's going to be much higher?
It does look like it's going to head smartly higher in April after the already big hike we've just seen. And there could be some places to find respite in the form of relief in levies and taxes. Having said that, those are once-off reliefs. Once you've given them, you can't give them again. And if you're gathering tax, if you need to gather tax and it isn't coming out of one pot, you'll need to go and find the tax that you've given up from some other place. So I think that would be more about rearranging the furniture than providing genuine relief. Where I've got a real concern for the South African economy is we've been in a growthless environment for the better part of a decade. We're now looking at an inflation rate that I think goes above 6%, the top of the South African Reserve Bank 3 to 6 tunnel. It goes above that 6 in the second half of this year, and it could stay resident there, which means we find ourselves in the textbook world of stagflation, economic stagnation with inflation. That's a very challenging place for the South African economy, and it reinforces, it reasserts the urgent call for the structural reforms that have been promised for so long.
Yeah. You've kind of gone ahead of my question, but let me ask it anyway. Of course, everything's going up. We're hearing that fertilizer prices are going to go up. We know that shipping costs have been going up even before this crisis, grain prices, not to mention fuel. So how do you think then the Reserve Bank is going to approach all of these challenges come their meeting later on this month? Are they going to view it as a mere blip, or is it going to be a real dent going forward?
One of the reasons we got such low interest rates was because of the very strong, bold, and I think with the benefit of hindsight, correct action of the Reserve Bank. to look after balance sheets and to protect the real economy to the extent that they could. Although that's outside of their mandate in terms of managing the real economy, I think that the decisions had important implications for the economy. And that was taken in the environment of hard lockdown. Although, I'm being sort of uncharitable about economic growth, it is fair to suggest that the economy has found a firmer footing. And with the economy on a better footing, we're now looking at inflation that is inside of the SARB range, but heading to the top end of the range. And given where interest rates are and given where the inflation rate is, I would venture that it is it would be inside of the mandate or diligent to hike rates at the next meeting. And indeed, for the balance of the year, it looks like we should steel ourselves for interest rate hikes over the course of the year. And we may not be done if inflation hits north of 6%. So I think that we should brace ourselves now for a round of interest rate tightening on the back of what we've already seen.
Thanks for the unfortunate warning, and thank you very much for your time. That's Dr. Adrian Saville. He's a professor of economics at Gibbs.